Hello, everybody. We're about 1 minute to go, so we will be proceeding at 11:30. So we'll give a few more seconds for people to start joining, and we'll get going. Okay, we are about ready to begin. I'd like to welcome you all to the Wealth Summit bonus webinars. Today we have the small business pension plans and safe harbor and solo 401k presented by David Blain. First, I'll go over a few house rules. Please save all your questions for last, but when David is done, he will take questions. I will unmute everybody, and if you have a question, just go ahead and unmute yourself and introduce yourself to David. I will introduce David now. David is the founder, CEO, and senior wealth advisor at BlueSky Wealth, a fee-only independent registered investment advisor. David is a recognized speaker on investment, financial planning, and taxes. David has written and been quoted in numerous trade journals and mass media outlets, including Money, Business Weekly, USA News, and World Reporting, and the Wall Street Journal, and other national and local publications. Under his leadership, BlueSky has received several awards and accolades through its history for their quality of advice, growth rate, and client satisfaction. He graduated in 1989 with a Bachelor of Science degree from West Point and served with distinction for 10 years in the U.S. Army Airborne Rangers and Special Operations Unit. So I'd like to present a warm welcome to David, and you're ready to go, David.
Okay, great. Thanks a lot, Nate. Welcome everybody today. We've got another exciting presentation for you on retirement business planning. And as Nate said, if you have questions, please, we'll have plenty of time for that at the end. Just type it in the box there for questions or raise your hand and we'll get to you. So if you recall, last time we had an overview of pension plans and we talked a little about the IRA-based plans. So today we're going to focus on two plans, the Safe Harbor and Solo 401k, that are going to be applicable for a lot of people. These are probably the two most common plans among small business, although as we get into section 3 and 4, I'm going to encourage you to take a look beyond what we're talking about today, but these are some great options that a lot of people have been able to enjoy a lot of benefits from. So we'll go those into detail. I wanted to bring up my little chart here again. This is a chart I made to talk about all the different types of retirement plans that are available to a small business owner. As you recall, on the last session, we talked about the IRA-based plans there on the right side of the chart. And today, highlighted in yellow, is where we're going to start today. We're just going to touch briefly on the profit sharing component. That's really a part of an advanced retirement plan, but we'll touch on it briefly today, especially for the solo 401k plans. It's definitely an applicable strategy at the basic level. So just to remind you, so the defined contribution on the left-hand side, those are ones where the company, the amount of money being put in is fixed at either nothing in the case of a 401k where there is no match, all the way up to the money purchase plan where the fixed amount is set from year to year. The defined benefit, there's no set contribution amount. What you're doing is you're targeting a benefit for the employees, and then of course the IRA-based plans that we talked about last time. So just kind of set the stage where we are. A quick review here of some of the benefits for why you want to offer them. For those of you who were on last time, I apologize, is somewhat of a repeat, but I added a few new things in there for 401ks, but essentially the big benefits: employer contributions are tax deductible, as most business owners are some sort of pass-through entity. Those deductible contributions flow through as a reduction in taxable income for the business owner. Likewise, there's some really generous opportunities for owners to put a lot of money away. Hopefully, you're running a successful business and you have tons of extra money that you need to figure out what to do with. And so there's some really great opportunities in the retirement plan for the owners. Lots of flexibility, lots of different types of plans, lots of ability to tailor the contributions and benefits to either the owners, select employees, or both. For those of you just starting out, there are some tax credits available for starting a plan. It's modest, up to $500 in the first year. The last point is, I think, one that is somewhat overlooked, is the ability to attract and retain employees. It's pretty much becoming ubiquitous throughout the large company world to offer retirement plans. And so if you have a 5, 10, 15, 20, or even 50 employee company, being able to attract and retain employees, you just about have to offer something for your employees. Speaking of employees, there's a lot of benefits to them. And as the owner, you're probably an employee yourself, so these apply to you. Of course, the tax on contributions and any gain that occurs within the account is tax deferred. They're portable. You can move them, the employee can move them from company to company, or they can roll them out into an IRA, which is nice. Most of them offer some sort of automated payroll deduction savings. That's the number one hindrance to people saving, is not doing it first. And this allows them to save their first dollars instead of last dollars. There's also something called the Retirement Savings Contribution Credit, that if eligible, they can get a credit on their taxes. Of course, the compound growth, which leads to that financial independence and residual income that we're all trying to create. So all in all, between the employer benefits and the employee benefits, it's definitely a win-win. So today we're going to focus on the 401k. So what is exactly a 401k? And I wanted to spend just a minute on that. The 401k was sort of started in a Revenue Act in 1978. There was a section called 401k of the Internal Revenue Code. That's where it gets its name from, that allowed employees to avoid being taxed on their compensation. And what's really interesting about this, when it was first passed, nobody really paid attention to it. But there was a benefits consultant named Ted Benna, who was researching, like all good tax and financial people, were always looking for ways to get around things or pay less tax. And he saw this section 401k in the code, and he said, hey, I think we can use this for employees to save pre-tax money into a retirement plan and have the employer match it. And at the time, it was a novel idea. And in fact, the company that he came up with this idea for rejected the idea, and they said, no, we don't want to do that, or that won't work, or whatever. So the first ever 401k was actually in Ted Benna's own company. He started it, and then somewhere around 1981, the IRS issued new rules that allowed much easier mechanism to fund these, and so the 401k really took off there in the early 80s. 401ks are governed by the Employment Retirement Income Security Act, otherwise known as ERISA, which was passed in 1974. Unlike an IRA or SEPs that we talked about last time, the 401k is considered a qualified plan, meaning that it has to meet very strict requirements of this regulation called ERISA. Now, it does allow for the tax-free deferral of wages. We already talked about that. Almost any business type can offer the plan. So corporation, a C Corp, a subchapter S, a self-employed, sole proprietor, partnerships, LLCs, just about any type of employer can offer a 401k. And it is a retirement savings plan, and it has to be sponsored by the employer. So it's not something that an employee can do on its own. And of course, they can defer wages. So they take a part of their salary and they defer it into the account. And that's an important concept. It's a deferral. The employee's money is a deferral into the account. It is subject to Social Security and Medicare wages, or I'm sorry, Social Security and Medicare taxes, but is not subject to income taxes for federal tax purposes. So that's the basics of what exactly is a 401k. There are all different types of 401ks. We're going to talk about the two, Safe Harbor and Solo 401k today. Some of the pros and cons of the 401k: it's most valued by highly skilled workers. You know, your more sophisticated employees, your employees that are more professional level, looking to save for retirement, they're the ones that most value it. Frankly, they're the ones that get the most tax benefit out of it. It has the highest employee contribution limits, so the employee has the most control over taking charge of their own retirement, as opposed to being dependent upon the employer putting something in. So you can see there the contribution limits: 19,000 plus a $6,000 catch up if you're over 50. It also has the highest total contribution limits, up to 56,000 or 62,000 if you're over 50, for a defined contribution plan. Now there's some defined benefit plans we'll get into in another session that have higher, but for defined contribution, it is the highest. The other neat thing, employees can choose to make pre-tax or after-tax contributions. Offers a lot of flexibility on eligibility, contribution, vesting, distribution, and employee loans and hardship withdrawals are available. Although I'll put an asterisk by that one. As an advisor, we typically discourage plans from allowing loans from the 401k. It's just not something that we encourage people to do. Hardship withdrawals sometimes are okay, but we generally discourage allowing provisions for a loan, and that's something you can do as the employer. So the biggest cons are the administrative costs are usually higher than just a SEP or a simple. And then, of course, the ERISA compliance is the big one. All the annual testing, and you have to file a Form 5500, which is like a tax return for a retirement plan. So there's a lot of compliance, and it's definitely not a do-it-yourself sort of thing, although the solo 401k comes very close to doing it yourself. If you have a safe harbor or any other type of retirement plan, you're going to need some help on that. So we mentioned this already, some of the contribution limits. I wanted to put it all here on one slide. So we talked about the deferral, the maximum contribution. The profit sharing portion, which we'll, as I said, we'll touch briefly on today, is 25% of compensation. For people that are self-employed, so this would be a sole proprietor or someone that's a member of an LLC that is not taxed as an S Corp, that's taxed as a partnership, the maximum profit sharing is 20% for a self-employed person. The overall compensation limit that can be considered is $280,000. And as we mentioned last time, the W-2 salary to maximize your contribution as an individual is $148,000. So at that level, for a standard 401k with profit sharing, there's no additional benefit to paying yourself a higher salary than $148,000. Now, as we get into some of the advanced retirement plan design, there may be, but if you have just a 401k, there's no way to get any more benefit out of it beyond paying yourself $148,000. Okay, let's just briefly recap on the Roth option versus the traditional tax deferred, and I've added one other bullet there at the bottom. So as you recall, when deciding whether to do the Roth option, which means there's no tax deduction when you put the money in, but when you take it out, there's also no tax, versus the pre-tax option, where you get a tax deduction putting it in, but when you take it out, you are taxed on it. So most plans now offer the option to do the Roth versus traditional, and it's a big decision for both you as the owner as well as for your employees. Remember, any company contribution to the plan is always pre-tax. And why is that? Because the company is taking a tax deduction for that contribution in a form of a match or profit sharing. And so when the employee eventually takes it out, they have to pay tax on it because that money was never taxed. The decision point on which one to use, of course, is the future tax rate versus today's tax rate. The future tax laws, of course, are going to impact this. We don't know what the future holds. So this decision encompasses a little bit of getting out your crystal ball and trying to see what's going to happen in the future. And it can be difficult. So we recommend, looking at this, and it can change from year to year. Some years we'll have people do pre-tax, other years we'll do Roth. And then the next bullet point, who's going to actually use the money? This is something that people overlook sometimes is, I am not a Roth 100% of the time, all the time, every time the best option. It's just flat not. If you're investing in a Roth and you're never going to actually take the money out and your children inherit it and they're in a very low tax bracket, well, you would have been better off with the pre-tax option. So there are a lot of considerations. One of the things that's unique about the 401k that I've added here is what's called an in-plan 401k rollover. This also has another name. It's called a mega backdoor Roth, where when you set up a plan, you can allow within the plan to do in the plan rollovers. So basically, you have non-Roth money within the plan. If that's either pre-tax, you can do within the plan, you can convert it to a Roth. Now, when they do that, they of course have to report that income as taxable income for the year, but it simplifies the process of the backdoor Roth. And if your plan allows you to make non-deductible contributions, it can be a really great option in your plan. So just keep that in mind. If you're designing a 401k plan, consider offering in-plan Roth 401k conversions as well as non-deductible contributions. Okay, this next chart here is pretty important. There's a lot of different players involved in a 401k plan, and not every one of these boxes has to be filled in when you set up a plan. And sometimes the same person or company fulfills multiple boxes, but it's very useful to walk through. So the most important person in the plan is one of the people in the three blue boxes. And this could be an entity or a person designated. The blue are the fiduciaries to the plan. So there's some fancy names: ERISA Section 402A, 316, 403A. Just remember, this is the fiduciary to the plan. And we're going to talk about what a fiduciary is, but it's basically the person that is in charge of the plan and is going to be held responsible if things go wrong with the plan. Typically, the named fiduciary is in fact the company itself, and generally a person. So for example, at BlueSky, I am the named fiduciary of our 401k plan at BlueSky. So that's going to be the blue box is the fiduciary. The next group of people are in the yellow. You can have there, it's a little bit hard to see, but an ERISA Section 338 investment manager is an investment manager that also takes fiduciary responsibility for investment selection and monitoring. This has to be a registered investment advisor. It cannot be a broker or insurance company or things like that. I mean, it can be an insurance company, but not a broker. You also see down here, you can have a financial advisor as a non-fiduciary or fiduciary advisor to the plan. We'll talk about that a little bit more. The custodian, so the green box is where is the money held? And you can have what's called a directed trustee or a non-fiduciary custodian. But typically these are going to be a brokerage firm like Charles Schwab or Vanguard would fit here. Here in the East Coast, there's a company called Mid-Atlantic Trust. It's a big directed trustee that custodies a lot of 401k plans. But these folks in the green, someone has to have the money, okay? The yellow boxes, the investment advisor, these are actually optional. The plan fiduciary, you as the owner of the company, you can select your own investments. In fact, here at BlueSky, since this is what we do for a living, we have no financial advisor or ERISA Section 338 investment manager. As the plan sponsor, I feel comfortable, with my blue hat on here as the plan sponsor, I feel comfortable selecting our own investments for the plan. So we don't have the yellow boxes. Now comes to these sort of orange boxes here. Two people. Number one is the record keeper. And the record keeper is responsible for tracking contributions, earnings, investments on a participant level and directing the trustee or custodian to execute trades as requested by the plan participants. Okay, so the record keeper is kind of in charge of the day-to-day accounting for the plan. The third-party administrator here, this bottom box on the left, is responsible for the ERISA compliance. So all the compliance of the plan, the testing, the IRS filings, the plan document, participant notices, and things like that. Now, there's a concept called bundling and unbundling. I'm going to talk a little bit about later, but a bundled solution would be where a lot of these roles are fulfilled by one company. So, for example, your insurance companies are typically a bundled solution. Some of the brokerage firms offer a bundled solution. An unbundled solution is where you hire these people independently or they form loose alliances. So, for example, at BlueSky, we offer an unbundled solution where we fulfill the financial advisor role and we have some preferred record keepers, TPAs, and custodians that we use. While there's nothing wrong with a bundled solution, that's typically where a lot of the abuses and some of the egregious fees take place, which we'll talk about in a minute. So the next slide, we're going to talk about the fiduciary responsibility. So once again, as the company, as the plan sponsor, you as an individual are probably going to have fiduciary responsibility to the plan. What exactly does that mean? Some of the fiduciary responsibility, number one, has discretionary authority over the administration and investments, and they're responsible either for doing it themselves or selecting the people and the firm that are doing it. What are the requirements of a fiduciary? They must act solely in the interest of the plan participants, not in the interest of the company, not in the interest of themselves. Although they are a plan participant, typically the owner, they can't act solely in the interest of their buddy, their broker who set the plan up. It has to be for the plan participants. They have to carry out their duties prudently, follow the plan documents in compliance with the ERISA laws. They must diversify the plan investments. This is something that, for example, Enron got in trouble with when Enron collapsed, is something like 60% of the 401k assets in the plan were invested in Enron stock. It's just an awful, awful situation. And then the last main fiduciary requirement is to make sure they pay only reasonable plan expenses. And there's a lot of lawsuits over this. In fact, Fidelity, one of the top 401k plan providers in the country, actually got sued by the participants in its own 401k plan for failing to meet the fiduciary responsibilities. They were offering only Fidelity funds in the 401k, even though they may have been more expensive than other competing funds. And so they got sued by their own retirement plan, their own employees. The 401k plan is technically structured as a trust, so it's separate from your company. It's a separate entity with its own tax ID, and it's the trustee, the fiduciary of that, you're responsible for it. Like I said, the employer is generally the primary fiduciary. Most third-party providers, so for example, if you have a CPA or the attorney that draws it up, or most financial advisors are not fiduciaries to the plan. They may have a fiduciary duty to give you the best advice possible, but it's a very subtle distinction in that they're not a fiduciary to the plan itself. Now, I don't have it on the slide here, but I wanted to tell you the 5 things that are the main sources of fiduciary liability today. What will get you in trouble? Number one, paying excessive fees. That's the number one thing today, is if you are overpaying in your 401k, you are subjecting yourself to liability. For example, at BlueSky, our 401k is completely free for our employees. Now, we're able to do that. We have an arrangement. Since we don't have to hire an investment manager, we do that. We provide that service for free. Our record keeping and TPA services are provided to our 401k plan for free by a third party because we use their payroll service. But and the fund choices that you use, we have all Vanguard and dimensional funds in our 401k, very low fee investments. Number two, selecting imprudent investments. This goes back to the Enron, is making sure that the investments you have in your plan are prudent for the types of employees that you have. For example, if you say, well, I'm aggressive and I like small companies, or I like emerging markets, if that's all you put in your plan, you're asking for trouble. You have to have conservative investments, moderate investments, and aggressive investments. Even the number of investments, there have been lawsuits over offering too many choices to unsophisticated plan participants. So as the fiduciary, you have to select prudent investments. Number three, not remitting the contributions on time. This is just like your payroll taxes. If someone defers their salary, you have to put it in the plan in a timely manner. Number four, not meeting reporting and disclosure requirements, all the legal requirements of the plan. You have to meet those. And then number five, simply failing to follow your own plan document terms. If you said you're going to match employees' contributions, then you have to do that. So those are some of the things that get people in trouble. As I already said, watch the fees. Administration, you've got a custody, record keeping, TPAs, administration fees. Investment management, the fund selection, as well as participant advice. And then, of course, the underlying fund expenses of the investments that are in your plan. All these different fees can add up, and it's been a huge area of abuse over the years. Some of these larger fund companies and insurance companies just layering on the fees that either the participants or the company pays. Okay, designing a plan. We're not going to go into this into a lot of detail today, but suffice to say, these are the 6 areas that you as the plan sponsor have to make decisions on. Number one, who is eligible? Number two, what compensation is eligible? This gets into bonuses and different things like that. Contributions. Who can put contributions in? What type? Do you have a Roth contribution? Are you matching? Those type of things, as well as vesting. Is if you match an employee's contribution, is it their money right away, or do you have a multi-year vesting schedule? The next area, distributions. What type of distributions are allowed from the plan? When do people have to take money out? Can you force them when they leave your company to take the money with them? And then, of course, last, we already touched on this, whether you want to allow loans or not. I want to focus in on one thing here of that big list, is the contributions. Once again, to emphasize, the contributions are made up of salary deferral, which is the employee putting their money in, the employer match, if there is one, and profit sharing. Now, employer match and profit sharing can be done one of 2 ways. Number one, it can be ongoing. The employee defers money. You can match it right there per paycheck. You can also do it lump sum. The match and profit sharing don't have to be contributed until the tax filing deadline of the employer. And this can come in really handy, especially for profit sharing plans. If you're not sure how much you can contribute, you have until the tax filing deadline to put it in. So that's a lump sum or ongoing. True up provisions is a complex formula that allows people to defer without regard to the match. So for example, if you have someone that is deferring a certain percentage of their salary into the 401k and you're matching it, if they meet that that threshold of pay early in the year, they actually may miss out on some matching contributions later in the year. So the best strategy is to have people withhold or defer equally throughout the year to maximize the match. It's a little bit technical, but suffice to say, to correct that problem, you can add true up provisions to your 401k that gives the employee the full amount of the match no matter when they meet their matching threshold. Okay, I want to spend a minute here on self-employed taxpayers on Form 1065 and Schedule C. Most people, most small businesses, unless you're really small or just starting out or something unusual, are going to be best served by an S corporation. However, there are still instances where someone is self-employed and files a Form 1065 or a Schedule C. Now, by definition, I run into this all the time, even CPAs, now not Kevin, but other CPAs, where they'll pay a self-employed person a salary. By definition, they cannot receive a salary. They do not get a paycheck. They either get a guaranteed payment or just distributions, and their quote salary, their self-employed income is computed on the at the end of the year. Did we just lose the screen? Okay, I did.
No, it's still up for us.
Okay, good. Okay, sorry about that. So they cannot receive a power, and they have different rules than salaried employees. Another quirk in the code is there is no concept of matching contributions that don't exist. Matching contributions for a self-employed taxpayer are considered a deferral and accrue to the deferral limit. The self-employed taxpayer or partnership with an LLC, you actually take the deduction on line 28 of your Form 1040 for your pension plan contribution. And if you are a 1065 partnership, that information gets reported on Schedule K1 in box 13. So if that applies to you, make sure that it's being reported correctly. It's a very confusing part of the code. Okay, so now I want to get into the two types of 401ks we're going to talk about today. Number one is the solo 401k, and that's what I call it. I call it the solo 401k. It actually goes by many names: the Uni K, the One Participant K, the Solo K. Frankly, these are all marketing things. There are different companies out there that they're marketing like this is something unique that they have, and they give it a name like UniK or whatever. It's technically in the IRS code. It's called a one participant 401k plan. Although I prefer what's called a business owner plan because it's not always just one participant on the surface. So for example, if you have multiple business owners, each one can have their solo 401k. So it's a little bit confusing. And so I just want you to remember, it's not just for a one person company. You can actually also have employees in your company and have a solo 401k. Let's talk about that for a minute here. So a couple things. Number one, you can exclude under age 21 employees, and you can exclude part-time employees. And this is where some of you may still be eligible for the solo 401k, where you can exclude employees that don't have a minimum of 1 year of service, and you can define that 1 year of service as someone who completes at least 1,000 hours of service in that calendar year or any other 12-month consecutive period. You could also go by elapsed time, could be whether they've completed a 12-month period of time. But if you're looking to have a 401k and you want to stay away from the expense of a full-blown 401k and stick with the solo 401k, keep this rule in mind because the solo 401k has much simpler requirements. There's no the compliance of it because there's only owners in the plan. A lot of the testing does not imply the top heavy testing, the deferral percentage testing, those type of tests do not apply because it's only owners. There is no, by definition, you can't discriminate against the rank and file employees if none of them are eligible. So this can be a handy thing to do, the solo 401k. It's just like any other 401k with in terms of the rules behind it, and the deferral limits are the same. The way the money comes out are the same. It's just a lot easier administration. In fact, you can set up, we do this all the time. For example, at Schwab Institutional, you can set up a solo 401k, and there's no annual fee at all to have it. And the compliance requirements are very simple. Now, once you get over, one of the rules for filing a Form 5500, once you get over $250,000 in the plan, you do have to file a 5500. But for a solo 401k, it's a very simple form to file. Okay, so that is the solo 401k. Pretty straightforward. Next, let's talk about the safe harbor 401k. So as I've alluded to in the presentation, one of the difficulties of the 401k is what's called non-discrimination testing. And what the IRS, when these plans were set up, is what they wanted to do was prevent the business owner from discriminating against the rank and file employees. And so they set up a whole host of testing that highly compensated employees, owners, they look at the deferral percentage, they look at contribution percentages. There's all these sorts of testing. That's where the TPA comes in, the third party administrator. They have to employ actuaries, and they do all these complicated testings to make sure that the plan is not discriminating against the other employees. In fact, before the safe harbor plan came out, if you would go through the year, and you would, as the business owner, you would put money in this plan. At the end of the year, the TPA would, put on his green eye shades and lock himself in his office, and he'd do all these calculations, and he'd come back. And a lot of times the business owners would have to give some of the money back. They'd have to take it out of their account and give it back, or they would be forced to contribute fairly large sums to all the employees in the company to pass testing. And so it was a real nightmare, and it discouraged employers from offering these plans. And so what the IRS came up with was the safe harbor plan. And what that was designed to do is give businesses if you offer these certain minimum benefits, then the plan is exempt from all the non-discrimination testing. And so sometimes in companies, if you have low adoption rates, so if the only people participating in the plan are the owners, you're going to fail the normal testing. And so the safe harbor eliminates that testing. It automatically passes. Now, one of the bullets there you see is it can be more, quote, expensive. And what does that mean? It means depending on how your company is structured, having a safe harbor may actually require you to contribute more to employees' accounts than otherwise you would have to. Now, typically that's an unusual case, but it does happen, and so it's worth looking at. But it's very simple to implement a safe harbor 401k. So what exactly are the differences between a safe harbor and a regular 401k? So the key provisions of a safe harbor 401k are, number one, immediate vesting. So an employee is always immediately vested in their own salary deferral. So if an employee defers so many dollars into their 401k and they leave the next day, they get to take their own money with them. With a regular 401k, the company match or profit sharing, you can put a vesting schedule on that, meaning you can make the employee stay so many years before they get to take that money with you. With a safe harbor 401k, you can't do that. As soon as the employer match goes in, it is the employees, and they are free to take it with them. Okay, there are 3 required matching. So this is another key component of the safe harbor, is you must match in some form or fashion. There are 2 types of match, the basic and the enhanced match. You can see the formulas there, but essentially with the basic, you match 4. If the employee defers 5%, you're matching 4%. And the enhanced match, you're matching 100% on the first 4%. So pretty straightforward. You're only giving money to people that defer their own. So people that don't participate in the plan and don't put their own money in, you don't have to match them. The other matching, and technically it's not a match, is what's called a non-elective contribution. And this is where you contribute 3% across the board to all employees that are eligible for the plan. And the reason I have an asterisk there is as we get into some of the advanced plan design, this non-elective 3% contribution to every employee allows you to pass some other plan testing called the top heavy minimum and gateway test that when we get into advanced plan design will become critical. So if all you're going to have is a safe harbor 401k, you need to look at which match you want to do. But just keep that in mind as we go forward, that non-elective contribution can be a powerful tool to give every employee 3%. The other thing with a safe harbor 401k is technically it's not always exempt from testing. And I know that I said that was the reason you do it. One of the key things, if you do have a profit sharing plan with your safe harbor plan, it will subject your plan to testing. So a safe harbor 401k is typically for the company that wants to offer something to their employees and to the owners that's very simple. But if you try to make it more complicated or get more money, such as with the profit sharing component, you will subject yourself to testing and kind of defeat the purpose to some extent of the safe harbor plan. So just keep that in mind. There are exceptions. Even if you set up a safe harbor plan, there are some things that you cannot do without subjecting yourself to testing. Okay, we've mentioned this. I'm going to cover the profit sharing in the next webinar, but you can have a standalone profit sharing or you can pair it with a 401k. It's completely discretionary from year to year. And the reason I bring it up here today quickly is for someone that has a solo 401k, there's almost no reason not to also do the profit sharing plan because you have no other employees. You might as well do it. You don't have to give anyone else any money. So it's a pretty straightforward calculation. Okay, where do you set up a 401k? Well, first bullet point there is you could go out and you could hire a pension consultant to custom design a 401k plan for you. Most people do not do that. They use what's called an IRS master or prototype plan document. It's already been approved by the IRS for use as a 401k. You can have an unbundled, which is typically an independent investment advisor like myself, that's what I am, or you could hire a pension consultant and they would piece together all the people that need to come together for your 401k. You can also get a bundled 401k, banks, brokers, insurance, mutual fund companies. Like I said, those are typically, you got to be careful with some of those. Even Vanguard, who has a great reputation for their funds themselves, their 401k plans are actually pretty expensive compared to some other providers out there. Okay, factors to consider, obviously the competence of who is setting this plan up. Do they know what they're doing? The fees that you pay them, of course, we already covered that, as well as the service differences. You know, what do they provide? Do you have a relationship manager, someone you can call, or do you just have a toll-free number? So that's pretty straightforward. Compliance, we already mentioned this. Number one, testing. You have to get your plan tested. Even if it's a safe harbor plan, they have to go through the motions of testing, but of course it will always pass if you follow the rules. The Form 5500, the IRS return, and then we didn't talk about this much, but there are participant disclosures that you have to make throughout the year to the participants in the plan, notifying them of the different features of your plan, and of course keeping the plan document up to date with the relevant tax laws. Okay, so does everybody understand this completely? I know the tax code, it can be very, very confusing. So now we're going to jump into some examples here of the solo 401k and safe harbor plan. So I'm going to shift my screen here to a A solo 401k, we'll start with that, with a profit sharing. And this is what I'm going to say. We've got two owners, husband and wife. They make a bunch of money, 148, 175 in salary. We go here to the contribution. What I wanted to show you, so the owner, the spouse here, the total contribution, $56,000. They make 148. The person that made 175, you can see they're limited to $56,000 contribution. So there's no incentive to pay more than that 148 number. Just keep that number in mind. It does change from year to year, but for 2019, that is the key figure. Now here, as you recall from last time, I always like to see what the cost of this plan is. So this is a no-brainer. This couple would save $27,000 in taxes if they were in the highest tax bracket by implementing this profit sharing with a high salary. Now, one thing we run into is people with a low salary, the CPA, they're trying to minimize self-employment tax. So we take the same company, but we pay each of them $25,000 instead of the maximum. And you can see they can still defer, $25,000 each. They get $25,000 put into the plan each, but you can see that the tax savings there is very modest. And so you just have to do a trade-off between the Social Security FICA tax rate, which I can guarantee you is a lot less than 37%. So taking it up to that maximum number is usually worthwhile if that's what you're trying to do, is maximize your retirement plan contributions. Still some tax savings, but much more modest tax savings as opposed to the larger salary. Now let's move over to the a safe harbor with no profit sharing. This is a little bit bigger company. You can see there's 12 employees, some people in the 100,000, some people in the 30, 40. I just kind of made this company up. So this is a safe harbor 401k. And I want to show you, so the principals get 74% of the benefit versus the non-principals. So the owners get 74% of the benefit versus 25% for the non-principals. But you can see it still costs them a little bit of money. Now this has no profit sharing component to it. This is the 3% non-elective match. So in order to get $52,000 put in their own account, 22 and 29 for the two owners, they had to give employees about $8,000. So, I think that's well worth it to offer that type of benefit, but some of you may think otherwise. The real power of this comes in when you offer the profit sharing. So that's an advanced plan design we'll talk about tomorrow. But I just wanted to, or not tomorrow, but the next webinar, but I just wanted to show you the very modest cost to offer this plan. So this was the 3% non-elective. Now let's take a look at where you have the regular match, which is where you only match the people that participate. Same company, same 12 employees. But this you're matching. So you can see here that the match for people and the total contribution of pay. And here the principals get 82% of the benefit, so a little bit more benefit. Remember, you're only putting money into the account of people that actually participate. And you can see there the net cost of the plan is only $3,000. So in this particular company's instance, you can see the difference between the 3% non-elective giving it to everybody and then only allowing people that participate in the plan to get a match. Okay. So let's get back to the slideshow here. Okay, so next time we're going to talk about the new comparability 401k plan design and also the money purchase pension plan, as well as we're going to delve more deeply into profit sharing and what that means for you. Okay, so now we'll go ahead and see if there are any questions here today. Okay, if you want to type a question in, or if you want to um, raise your hand or something like that, we'll go ahead and take any questions that you have. Nate, can you see if someone raised their hand? Can you unmute them?
Yeah, everybody should be unmuted, and you just need to unmute yourself and start talking.
Hey, David, this is Alice Paxton.
Hey, Alice.
Hey, and you may have answered the questions. So I, as an owner, am taking a owner's draw. I don't draw a salary. So
So you are a sole proprietor or
I'm an LLC,
an LLC, and a single member or multi-member?
single member at the moment, but we want to be able to offer it to our key employees or to our
Okay.
employees.
So this is, you fall into this right here, where as a LLC, you're going to actually take the tax deduction on your personal tax return.
All
Now,
right.
you offer the employees, it's the same. If you offer a 401k, the company matches or whatever, and you take that deduction on your corporate tax return, but your personal tax deduction is actually computed on your Form 1040 if you are self-employed, LLC, single member, or partnership.
So, okay.
So you can't compute. So your allowable contribution is based on the net income of the company, and that has to be computed first before figuring out how much you are allowed to put in your plan. But you do not have to, as I said, you don't pay yourself a salary. At the end of the year, you compute how much that is, and then the company, the money can come from the company, and then it goes into your 401k account, and it's considered a distribution or draw from your equity account.
All right.
It's confusing. All I can say is, if the sole proprietor and Form 1065, multi-member LLCs, the retirement plan, it's very confusing the way that partnership tax law is set up. It's quite confusing.
But should my 401k provider be able to figure that out for me?
Um, depends. It
Or
depends.
is it a question for my CPA? Or
Yes, although I have seen, not to, diss any CPAs, but I have seen plenty of CPAs do this incorrectly. So
okay,
suffice to say, Alice, you are afforded the benefits of the 401k. As I showed, I don't know if you were on the webinar last time, but in order to reach the maximum contribution to a 401k as self-employed or 1065, you actually have to make more money. So my point would be, I would seriously consider looking at an S Corp election. It's going to allow you to put more money away at lower income levels, number one. And it's a much simpler for retirement planning.
okay. And I think that we're going to do that this year. So I'm not going to worry about it until we do that.
Yeah.
Right? Yeah, and I'll check with Kevin on it.
Oh, Kevin's your CPA. Yeah, he'll know he'll know
Yeah.
how to treat it correctly. Yeah.
Okay. Thank you.
Okay. Uh, okay. Let me see. Could a business owner fund a 401k and do a Roth personally? Great question. Yes, they can. So, depending on your income limits for the year, you can do that. The limit for to fund a Roth IRA is somewhere in the 180 to 200 range for married, 120 to 135 for a single person. And so you can do that. You could, and fully fund your 401k at work. You can also do, if you make too much money, you can fully fund your 401k at work and do a backdoor Roth personally. Okay, question, as an S Corp, can I defer 100% of my salary if it doesn't exceed 62,000? Yes, you actually, the limit is 100% of your salary. Now, you have to pay yourself a little bit more to account for the Social Security and Medicare. So you have to gross up your salary a little bit to do that. But yes, you can defer 100% of your pay into the 401k. In fact, for those of you that are married, one of my favorite techniques is to employ the spouse, especially if she's a corporate officer. You know, if she doesn't go to, like those of you that know my wife, Caroline, she's not going to actually do financial anything. That's not her cup of tea, but she is a corporate officer, and we pay her a salary, and it's a great way to get extra money into the 401k. Okay, let me see. Nate, I have a hard time seeing the questions. It's really small. Let me see. I answered that one. I think there's one more. S Corp, Roth. I think this was you, Alice. Automatic payroll deduction.
Yeah, that's me.
Yeah. Okay. Yep. So we answered that one also. Okay. Any other questions? I think we've answered them all. So next time, as I said, we're going to start getting into the advanced retirement plan design. So we're going to add profit sharing to our 401ks. We're going to see how that impacts our ability to put more money away. We're also going to talk about the fixed contribution, the money purchase pension plan, which not a lot of people do anymore. And then we're going to start touching base on the we'll run through some examples of what are called new comparability 401ks. And this is where you can, the IRS allows you to segregate every different classes of employees. So you can have an owner class, and you can have a admin assistant class, and you can have, you can do it ad infinitum to where each employee is actually their own class. And without boring you with the details, what it allows you to do is pass the non-discrimination testing a lot easier by separating your employees into different classes. And so it allows you to have a regular 401k plan reach higher levels of contribution for the owners, but still pass all the discrimination testing. So it's some really neat, we're kind of building up. We started with the simple last time, or not the simple plans, the SEP, and the IRA-based plans is simple. And now today we went to the 401ks, the solo, and the safe harbor. And now next time we're going to get into some really neat planning strategies that you can use with 401ks. So if there are no other questions, Nate, I think we're right at the time.
Okay, yeah, I'm not seeing any new questions.
Okay, if you do have questions, obviously everybody knows me. We were in Maui together. Just shoot me an email, and I'm happy to answer them offline as well.
Okay, thank you everybody for coming. We will be ending the webinar right now. Thank you.